So I'm going to see if I can blur and unblur my background. I'm calling in from New York City today in Central Park. Here we are out and about in the park. Uh, Loretta, where are you? I know Marty's in Texas
Oh,
somewhere
I
here.
just left New York City, went back to Atlanta to get work clothes, and now I'm sitting in Orlando at the Fair Lending Colloquium. What could be more fun? I just came off of the podium at 2:30.
How'd it go?
It was awesome. It's good. It was a good panel, all about data and telling your story. So it was nice.
Well, that's good. Today we'll get into if lending is going to become more or less fair over the next 4 years. So
Sure thing.
hear your take on that. Mr. Green, where in Texas can we find you today?
I'm in Dallas, Texas. It's a beautiful day in Dallas.
Good. Glad to hear it. Uh, so Loretta, I always like getting dispatches from the road. Can you fill people in on the conference and what the big talking points were and those sorts of things?
Sure. Sure. So since it is, of course, a fair lending and CRA colloquium, that's the focus. There are tons of regulators here, both at the podium and in the audience and mingling and schmingling. I think the big message is that don't rest on your laurels or think because we've had a change in administration that it's okay to take your foot off the gas on all the things that you're doing. That regulations are slow to come and slower to go away. And a lot of strong messaging from the Department of Justice that we look back 5 years. We're going to look at your data for 5 years. We're going to look at your outreach efforts. A huge focus on redlining, not surprisingly, making sure that you really get out there and are making efforts to lend to folks in all communities, not like back in the olden days where it was okay to have a business model, for instance, that we're just going to lend to high net worth individuals. It's more important than ever as a result of the settlements with the DOJ that every single session I've attended, someone has mentioned that. Another hot topic is, of course, the use of AI, not just in marketing, but underwriting and other models, and the importance of testing for that to look for possible bias. So I would say those are probably the two hottest topics in the couple of days, all the sessions I've attended and presented at.
Well, before I get Marty's opinion here, I do want to say hello to everybody that's joined already. This Regulation Central presented by Polunsky Beitel Green. Thank you very much, Mr. Green and your firm for sponsoring this. Those of you that may not be familiar with their capabilities or the insights they can provide, check out mortgagelaw.com. There's some really cool stuff on there. Marty, I'm going to take exception with something Loretta said. She said she was talking about redlining. I heard redlining was a thing in the past. What the heck's going on?
Well, that may be a little premature, certainly from what Loretta has just told us, and I think that's probably right. It's interesting. You do have a more dramatic change in terms of administrations, perhaps this time than any time that we've seen, in the sense that you have an administration today in the Biden administration that is very hyper-focused on things like fair lending and the like. And you have a Trump administration that's coming in, which I anticipate may be less so. But what Loretta just actually pointed out, which I think is a great point, is you can ignore for a little bit maybe what the Department of Justice does, because you're going to have a lot of states that are out there. And just because you have a change of administration at the federal level doesn't mean that you have one at the state level. So I think that you're going to see regulators who have been very attentive to that continue to be. Whether you see some softening of the stance at the federal level is yet to be seen, but that is a possibility. But as Loretta correctly points out, I think these things are very slow to evolve sometimes. So I expect more of an evolution than a revolution on those points, and it'll be interesting to see how the Trump administration hits the ground running in terms of changing things as it relates to that. Because keep in mind, a lot of their voters benefit from some of these enforcements actions. So it'll be interesting to see how they play out at the end of the day.
And I should say, Loretta, the point of this show, and thank you very much for joining us, and we very much appreciate having you, is for me to talk as little as possible. So
Oh,
if
okay. I'm
anybody says,
happy to interrupt and jump in at any time. Well, and
Please.
playing on that, the other thing we often see is if there's a change in administration in one direction, then we might see the pendulum swim in other places. Like you might see consumer advocates step up their game, not just states. Sometimes states will fill the void, but now, the HMDA data is publicly available data. A lot of talk now about, not probably relevant to this audience, the 1071 small business lending rule, the same idea there, like HMDA collecting data and looking to see who's served and underserved. And those are opportunities, but they're also opportunities for the plaintiff's bar, whether they're motivated by greed or passion, because either way, they're tenacious. And so even if a regulator isn't going to get on your case about something, it might be that you have a customer who was denied, or they had a neighbor who got a better price, or you have consumer advocates looking at certain neighborhoods that are underserved, and they're going to come in and hand it to you, and it will make dealing with your regulator look like a picnic, because oftentimes those folks are very unreasonable, and the cost of settling with some of those folks can be much more expensive than if you were dealing with an examiner. So it's important that we all want to think about. And the reality is, especially in this market, everyone wants to make money. It's green, right? And any mortgage person will tell you they'll make a loan to anyone they can, and they're trying hard to get into markets and certainly get as many apps as possible. So it's a matter of how do we fill those funnels in a cost-effective way to improve the bottom line.
Yeah. Well, one thing, Loretta, I'd just like to get your thoughts on that we've seen a lot of redlining cases sort of focus on is where people are opening branches, which when you're talking about independent mortgage companies, it always seems to me that's kind of a head scratcher, because so many people work remotely today that they don't even go into the office that they're assigned to. So where that office is seems to matter less. Do you see the regulators sort of taking that more or less into account going forward? Because they seem to be looking at the redlining sort of standards from a few years ago before people worked remotely. And so
I think that's true. And, I think a lot of the things when we look at these settlements, the first criticism is that nobody in this institution was even looking. And then when they looked and they saw something was wrong, and they just didn't try to solve it. So I think there are lots of ways people can try to solve it other than putting a physical location. To your point, Marty, people aren't going to walk into a branch anyway. So what is it you're going to do? And so we work really hard to counsel clients on all the other things they can do. Is it hiring loan originators who go out in certain areas? Is it targeting your marketing in certain areas? Is it having home buyer seminars? Is it, investing in the community? There are lots of ways you can do it. And these are some things that come from the roadmap of these DOJ settlements. But we look at people sometimes, just the images in their marketing online are a bunch of white people. I'm like, really? I looked at a website for someone last year. Every single person on their website was white in 2023.
Right.
I was like, are you kidding me? So there are simple things you can do that demonstrate that you're there to serve all. Certainly it helps if your workforce looks like the populations you're trying to serve, which doesn't mean you have to be out somewhere. Putting your investment into communities and programs. We have one independent mortgage lender client who's been really terrific and creative about going into communities, working with community development authorities and nonprofits in certain areas that are underserved or credit deserts, then getting involved with the small businesses there and having those small businesses like in the food deserts, that maybe there's one grocery store that they hold something there that's a credit counseling or home buyer seminar, and then they buy all the food to cater it from the grocery store, and then they have babysitters for the folks to come. And it's really taken a while, but they built trust in the community. They're known there. And I can assure you that if anyone looked in and thought that they weren't serving people of color or certain communities, they would have all of this fodder and pictures and all this investment they had made to make it happen, even though it might be a long time coming. I mean, I know I can barely hire a man, let alone, people of color. So I know it's hard.
Yeah, it is. And certainly your points there are well taken in terms of, even if you're a small IMB that doesn't have a whole lot of loan officers, that your marketing materials and other things can certainly make it clear that you are extending, credit in those communities that might otherwise be underserved, even though you may not have hired loan officers from that particular area.
Right.
I get the sense that there's this talk of, oh, there's going to be regulation that, there's going to be deregulation. The CFPB is going to be defending. It shouldn't change best practices for mortgage companies. Nothing should really change. And we're not here to give legal advice, but you should still have sound policy procedures, still be trying to avoid these things that could be red flags, right?
That's right. That's
And
right.
it's economically advantageous.
Yeah, it is.
It makes sense, especially now to try to bring in as many apps as you can. And with the deregulation, the other message, and I think it's granted, there are a lot of people here, we're all compliance oriented, and some of them like to use scare tactics. And no regulator is ever going to tell you to stop,
Right.
stop following the law, or let's, go back in time and pretend some of these things aren't going to happen. A lot of these regs are already far down the path, even things that haven't been implemented yet, and things that have been implemented. It would be more costly for lenders to have to backpedal and undo them. And we have a lot of career administrators who are still at the agencies who are invested in these efforts. And, part of the laughing was there was a guy who spoke, who's a political consultant. He was a lobbyist with the ABA for many years, and other folks saying, like, does anyone think Trump is going to talk about CRA? Of course not. Like, why would that even be on his radar? Maybe certain things will be, because he'll change financial markets or change other kinds of, opportunities, or crypto, or, do something about Basel. But the things that are day to day for the in the trenches mortgage professional, I think aren't going to change quickly. And we've even seen that the anticipation of rates, plummeting in the face of a red wave, that didn't happen. And, Robbie, your dad, he was here in Atlanta last week and was talking about that and rates and what rates are doing. And, we don't know. And it's not been like the panacea, just the election results.
No, actually, I think it's been the opposite in terms of rates, at least so far. The expectation right now that I hear from folks is that rates may actually be higher than they would have been otherwise had you had a Harris administration. Whether that balances out over time, we'll see, but that sort of seems to be the immediate expectation that I'm hearing. One thing that I think is possible, Robbie, in terms of just sort of the new administration, if you look at Trump 1.0 or whatever, the CFPB in that instance was certainly a little bit different than the CFPB before and after, but not dramatically. And I wonder if that's something that we may see in a Trump 2.0, is the CFPB, who's appointed director, may be more apt to really want to change things more permanently, because I think I could see a Trump 2.0 wanting to sort of thumb the nose at Elizabeth Warren's brainchild, if nothing else, because he sees that as a vindication of himself in some way. So I could see that happening. What do you think in terms of that, Loretta, possibility?
Well, he's definitely, I mean, Chopra's out, whether he walks out on his own or gets kicked out. I mean, we all know that, right? And I think whoever's there, under Trump 1.0, it wasn't like everything stopped. There was still investigations that were ongoing, but I think what we saw is a reasonableness, more of a collaborative regulator like we used to have back in the day. We didn't see this whole, more adherence to less intrusion by the regulator. And we know already under Chopra, there's been a hesitancy to do things the right way and to go out with real rules. Instead, there are proclamations, blogs, reading the tea leaves, I don't know, smoke signals, all these other things. And we're all supposed to figure out what that means, what applies, especially in a post-Chevron world. So I think what we'll see is whoever is at the helm, that we won't be seeing all these prognostications that we're all stuck with to try to figure out what to do with them. And hopefully when there are investigations or referrals, there'll be cases where something egregious is going on. Or a clear violation of the law, which, most people with the prescriptive regulations, they don't violate those, with other things that are squishier, RESPA and stuff, maybe the industry will get the benefit of the doubt, is what I'd hope.
Yeah, I think you mentioned RESPA there. One of the things I guess that the NBA had proposed, it's the 50th anniversary of RESPA. for reform. Brian Levy, who is participates in this often, was on that committee, I think, that made those recommendations.
He was at the helm of one of the task force, right? That we were on the
Exactly.
committee.
So I could see that being an area where we could see some progress and maybe see some clarification and bringing that really up, because it's 50 years is a long time. I really did think it was interesting when they first talked about it at the NBA conference. One of the things that someone pointed out is if you look at MLS back when the RESPA was first sort of enacted, it was actually a book that you had to go to the office to look at. And that's how long ago it was. So obviously bringing that into the current environment would be really, really helpful, I think, overall. And so I really do applaud them for the changes that they proposed. And I think it would be well served by the industry for those to ultimately be adopted, at least in some form.
I think you're right. I think things where there's areas where the practice or informal interpretations and enforcement change, that can happen without any formal action.
Right.
The regulatory changes can happen relatively easily. Some of the things would require a legislative change. I think those are less likely to get the attention of Congress because it's just, you know, I live in that world and spend a lot of time in the world, but for most people, they don't give a rat's patootie, right? So it's not going to be high on anybody's radar, but there are going to be a lot of opportunities for things. And maybe we'll see some help too related to ECOA, who also turned 50, you know, apparently. And with this whole idea about does ECOA extend to prospective applicants, you know, maybe there's something that would change in that regard to provide more clarity, make these laws more prescriptive, and give us a roadmap to compliance. If they can garner anyone's attention.
Yeah.
I think that's really the key. And I don't know, I can't imagine, like, is it really worth the political lift to try to throw out the CFPB when instead you can just render it toothless, maybe?
Yeah, or bring it into appropriations, maybe. That's one way that you can make
Yeah.
it more sort of less insulated from certainly the political influences of it. So that would be one thing that they might do, is change the funding mechanism. That would be something. But again, that requires legislative action. And so you have to really want to do it badly to try to get that political will to do it. So it'll be interesting to see. It's interesting you mentioned just the applicants under ECOA and prospective applicants, that people forget that that case that Townstone was just settled, but that was actually brought originally under Trump 1.0. So that was the CFPB under the prior administration, prior Trump administration. So that tells us that they were also focused on some fair lending issues for them to have brought that.
That's a very interesting case for you to mention, because there was some chatter out there that, you know, if that deal that they were offered before the election was going to be as good as it would get under a Harris administration. You know, like, they might as well take it if they thought Harris was going to win. Trump was expected to win. They took the deal when it could be the CFPB is defanged a little bit, or defunded, whatever you might say. Yet, I want to transition this towards Trump's goals for CFPB. What you think it's going to be, like you mentioned there, Marty. It's not like it's just going to be do whatever you want. You know, they bring fair lending cases. They still act as an oversight and watchdog. And it was just a little different in terms of being under Kathy Graninger, in terms of shooting first and asking questions later, versus they weren't scared to bring cases.
Yeah, I think that they're not gonna regulate so much by settlement agreements. I think that's one thing that you will see that's different about Trump administration versus a Harris, where you might have seen a lot more of that, certainly with Chopra and others. So I think that you're absolutely right. It's not going to be dramatically different, but it is going to be a kinder, gentler sort of regulator, a lot less active regulator. I think a lot more attentive to what the industry tells them, because at the end of the day, the thing that this administration will probably want to do is look at the regulations a little more pragmatically as to what they really cost ordinary Americans, because oftentimes we have a very worthy goal in terms of stopping something with respect to a small percentage of the population, but the cost of doing that makes it more expensive for everyone. And the question that we have to ask societally, is that a good trade or not? Because you aren't going to have a perfect regulatory environment for everyone. You're not going to have issues that don't happen on occasion, But again, the cost of preventing those may be really expensive for everyone, and raising the cost for everyone may not be the right answer.
Well, and it might be that because of Trump's constituency, that there are certain areas that are pro-consumer that he would still advocate for, like, the overdraft fees or things, especially if people who are struggling, people who are concerned about the economy, if they're
Yeah.
getting in a pickle and they are paying excessive fees, or while we hate the word junk fees and it's not an accurate assessment of the cost of obtaining mortgages, there might be other things that would be consistent with his agenda to drive costs down in certain areas, not just mortgage, but generally, or some of these things that relate to capitalization for banks or other things that might
Right.
benefit consumers and provide more access to financial services in an affordable way, or help people to achieve their financial goals. So that maybe could somehow fuel the economy in a positive way. And I'm no economist, so, I'm not sure where and how that could happen, but also help with his messaging.
Right. Right.
Yeah, I'm wondering. I'm sorry for making you both speculate here, but when it comes to ECOA or RESPA, what do you think some of Trump's goals are uh, on the things that will affect the mortgage industry?
I can't imagine he's even thought about ECOA or
Was it?
RESPA. I mean, I don't think that's on his radar. The only messaging I really hear related to, consumer financial service products is all about Bitcoin and, cryptocurrency and these alternative models, technology, things that are more innovative, to bring more innovative financial services. I haven't heard any talk about how those might be structured or how they might play into consumer protection statutes. And I know that just talking with developers now, some of the things that they're contemplating as alternative models to traditional home ownership, and home ownership financing, are models that they contemplate are outside of the regulatory scheme of RESPA and ECOA and TRID, but they're not. They're probably not, at least not how they've been defined to me, because they're just alternative ways of holding title or financing your right to occupy a dwelling with some kind of inchoate legal right. So, there's a lot of development there, and it might open the opportunity to present these issues to the CFPB in a way that under a Trump administration and a new director, they would be less restrictive for those innovative technological platforms. But I think it's just too early to tell. And, the CFPB had this whole concept about the sandbox, and where folks could look at alternative underwriting criteria, or have the safety to build innovative products to serve consumers without the fear of retribution or violations of ECOA. And so it's possible, I think, that we would have more space for innovation under a Trump presidency, with less cynicism about the goals of the folks who are those developers, that it's not the evil empire or some nefarious purpose to take advantage of the downtrodden. So I'm hoping that it will make more room for innovation in this space to help, both with housing and with credit.
Yeah, I tend to agree with you. I think the innovation piece of that is one that they will be focused on. I think it's probably, as Loretta said, less on the specifics of a COA or RESPA that's really going to catch their attention. There may still be an opportunity when you're in a broad umbrella of reducing regulations or bringing regulations up to date to maybe get some adjustments with respect to those, but I don't see that as being a huge priority. One area where I think you could see, and that you did have some attention on during Trump 1.0, was having to do with Fannie and Freddie and bringing that out of conservatorship at some point, those two entities. And so I think that's going to be something that will be reproposed, or at least discussed very much with the new administration. And it'll be interesting to see how that plays out, because I think that has a more pervasive effect in our industry than almost anything else that they're talking about.
Well, I did want to get to the Fannie and Freddie thing for the second half of the show, because I know it's what everybody wants to talk about. Before we move on, though, any other opportunities that come to mind for lenders, originators under a Trump 2.0? Innovation is obviously a great one, and thank you for bringing that up, Loretta. Anything else you see as ways that this will benefit the mortgage industry?
I could see some reconsideration of some of the LO comp rules to be a little
Oh,
more,
please,
yeah,
from your lips to God's ears.
to see what happens in terms of just being a reality in terms of what the economics are and that consumers benefit from it, and it gets the industry and the consumers' interests aligned in a way that might be meaningful. So that's something I think that a CFPB, a new CFPB, may very much be open to, and that the industry would applaud.
And that's something that the regulators can do. You know, there's a lot of room there. MBA used to have 3 asks, you know, they were on their way to getting a yes on 2 of the 3 asks about, you know, certain bond and DPA programs. Certainly that a lot, as you know, it started with this internal, I guess, tension at HUD about compare ratios, and then at the same time reaching out to folks in all communities, and then just the cost of generating loans that are DPA loans when you have to pay the LOs, the same thing. So a lot of lenders pulled out because of this tension and concern about their compare ratios. And then they got hammered, the ones who stayed in, that you still have to pay your LOs the same. And the cost of producing those loans, they're loss leaders. And, you know, maybe some stay in the game because they feel it's right ethically, or because they want to keep their real estate partners happy or their funnels full. But you know, that's been horrific. So if we could get some relief on that, so that would be a consideration for LO comp, and maybe for when things go sideways with a loan, that you could reduce the LO's comp, or the LO could volunteer maybe even to do that, to reduce price to meet competition, which I don't think the CFPB was inclined to give in on that third one. But under a new regime, I think that there are ways that we can demonstrate that, yes, we all get the LO comp rule was a fair lending rule, and it's there to prevent LOs from upcharging consumers so they can make more money. But that's very different than having no opportunity to reduce price to meet competition. And there are other ways that we can control for that risk. So I would love to see that happen. And I think that has legs. I think
agree.
whatever happens, obviously I think it's going to have to be pushed by industry, because I just don't think that these things, the in the trenches mortgage regulation, are on the radar
Right.
for a Trump administration. And that doesn't mean we couldn't put them there. And it might be just an easier ask.
Well, and I think if you couch that, the LO comp rule, particularly meeting competition, as something that definitely benefits consumers and lowers the price of home ownership, and that's how it's packaged, that seems to me to be a win-win, and that is a public relations sort of blessing to most folks out there in terms of how it can be presented. So I kind of
Right
hope they
on.
do that.
And especially the bond loans and DPA loans, you know, there are
Absolutely.
loads of people, you know, to develop these products and make them more readily available in the marketplace. Would
Right.
be awesome. You know, people are looking at things like special purpose credit programs, and those are very difficult to operate and administer. It's virtually impossible for anyone who's not a large institution. So maybe there are more opportunities there as well to do something to give folks the room, hand in hand with innovation. But looking at other opportunities to make credit available, and knowing that maybe, you know, sometimes it's not exactly compliant in this world, but they have the outcomes we want, which is to get more people in homes and originate more loans. And, you know, there are all kinds of opportunities out there with housing authorities, and that there just aren't enough lenders who will bring that to market, because they can't afford to do it. And they can't afford to do it now.
Right.
I mean, maybe I can't imagine, you know, another hot issue that's always been a hot issue in the mortgage industry that relates to LO comp is just this issue about minimum wage and overtime. You know, when everything got slow, lenders had to decide, what am I going to do? And I can't afford to keep all these LOs. If there were some alternative model, or we could know they really are all outside salespeople, or we don't have to pay them minimum wage and overtime, we don't have to make them keep their time, which they hate to do. You know, maybe there's some room there for something as
Right.
well. But I think whatever is brought to bear, it's going to have to be the industry advocating for it, and then having a positive response from the regulators and the administration.
Right.
Do you believe MBA as currently constituted is strong enough to have to, you know, get to the table in Washington and advocate for what's right? for its as currently constituted? Because I've heard some things where we're not getting what we need out of Washington D.C. from MBA from a lot of lenders out there.
Well, I don't know. I'm not in the room where it happens, the room where it happens. I hear the MBA messaging. I think some people there are effective. I think oftentimes MBA's agenda is driven by some of its larger members, and not surprisingly, that's how the world works, right? And I think that things, what the hot topics are, change over time. So like the LO Comp was a perfect thing. Like that was like number one, I think, on the agenda, and they were hitting that really hard. And then I don't know why, I guess it fell off the radar. And maybe that was because of the CFPB's lack of interest. And then we moved on to RESP fund that could be perceived as something that came about for other reasons. So, there are two sides to the MBA, and they're getting the audience, right? Part of it's their lobbyists and the legislative side and getting the action on the Hill. And the other half is the regulatory side and working side by side with the regulators. And those are different teams that work together, but in different ways. So, I don't know. I'm a member of MBA. I'm a fan of MBA. They're good people. They do their best. I don't know. Like, are they doing enough? I don't think anyone over there is, sitting around twiddling their thumbs. I know anyone I've ever worked with at MBA worked a lot harder than I ever do. The bar is low, but they work, they work 7 days a week. They have mountains of paper. They're constantly engaging with members. They're advocating for members. They're educating. Many of them wear many hats. So it's easy to grouse when you're paying your membership dues and you're not seeing things happen, but that doesn't mean that the foundation isn't being laid or that they're not making efforts, and I sit in Georgia where, change is slow and it can be very difficult. And I look at certain legislative things I do in my role as legal counsel to MBAG, and I'm busting my ass and I'm spending hours and days on projects that no one would ever know.
Yeah.
Because sadly, sometimes they're fruitless. So I suspect there's a lot of that too, things that happen at MBA behind the scenes, and that sometimes you're in a no-win situation.
Yeah, and I think that's where they've been, is you have a Congress that has been the least productive Congress in memory, just because of the divided nation that we are today. So expecting them to somehow produce legislative wins in that environment is unrealistic. So I think what they've done a very good job of is setting the stage for potential change going forward, as opposed to, evaluating it based upon what statutes got passed in the last legislative session or the one before, or what regulations got changed. Because as Loretta correctly points out, these things happen incrementally and they happen over time. So them raising the issue repeatedly with the people at the CFPB may not have meant that they were going to be changed last term because Chopra wasn't open to it, but those same people heard those things for the last 4 years. And now when there's different leadership, they may be much more open to it as a consequence. So I actually think the collective voice of the MBA is actually very valuable, but I think engaging them in terms of legislation probably isn't fair, because no one was able to really get any meaningful regulation passed in the last few sessions. So,
and some people might criticize them that they haven't sued the regulators. The ABA, the American Bankers Association, has, and one of the guys this morning from the CFPB said, yeah, being sued is just part of being a regulator, which, I'm a lover, not a fighter. I'm not suing anyone, and I'm sure not suing a regulator, because that's not going to help me have a good working relationship with them going forward. But sometimes, maybe that is what's necessary. And in my experience, I don't recall the MBA ever bringing a legal action against any of the regulators, whereas, that has happened with the ABA. So maybe that's part of what people grouse about if they see other professional associations take that step. And that, of course, is a big investment in another way.
Yeah, for sure.
Not just reputationally, but financially.
It is. And also that you have I think the NBA's approach has been more collaborative with the regulators for sure. But had the regulators come up with some of the rules that the bankers have had to deal with, they went ahead to take a different approach. But they haven't so far. You're correct.
What if I say something like credit costs have been a big deal recently? The MBA has the 3 credit reporting agencies as members. So isn't there like conflicts of interest where they're not always acting in the best interest of their members.
The NBA has a large constituency to try to please. There's no question that's the case. And sometimes they have to make choices that are at odds with one member or another, and how they make those choices kind of dictates how effective they are. And you're right, if they're trying to please every single one of them, including the credit agencies, that's going to be difficult for them. I think they
And the
balance that
people who
risk
are
pretty-
selling to the resellers, right? Who are their
Right.
members.
Yeah.
I'm sorry,
well,
I interrupted you, Marty.
No, you're wrong.
So we have 9-10 minutes left here. I do want to talk Fannie and Freddie, but I also want to make it where people can understand. In your best way you can explain this to somebody like me who's not nuanced in this. Why, if I'm the federal government and Fannie and Freddie are making billions of dollars a year, do I want to get them out? Is it like me living on my dad's couch and he says, I love having you home, but at some point you got to go? Like, what's the best, most logical way to view getting Fannie and Freddie out of conservatorship?
Well, I think you have to look at it from the prism that conservatorship is not a natural sort of place for them to be. It was sort of an unnatural place that happened as a result of the financial crisis. And so the impetus to get them moved back is really to really serve the original statutory sort of provisions with respect to it. Now, I think that it may go beyond that, because I think there is a movement in the administration with certain folks to potentially make them more private than what they would be at just outside of conservatorship. And that's where I think the difficult arguments are going to be, is how privatized do you want them? How much of a government guarantee is there going to be? And then what's the impact on interest rates of one choice or another for ordinary Americans? Because I think we've been well served by Fannie and Freddie in terms of the government guarantee, in terms of lowering overall cost of credit. And so the timing of trying to take them completely privatized in a way that may be more extreme than what we had before is a little bit difficult, just because it would cause a spike in interest rates that would actually impact affordability probably negatively. At least that's what the critics of that, the plan that was proposed at the first Trump 1.0 have pointed out. Whether they're right or not, we'll maybe find out at some point. Loretta, what are your thoughts?
Well, I'm no secondary market expert, but clearly when I came up and started the law firm, I came from in-house at basically a subprime mortgage lender.
Mm-hmm.
And so there were all kinds of things happening, and more room for private securitizations, more room for diversity, more ways to serve all kinds of people with all kinds of credit profiles. I mean, shoot, I made a mortgage loan to my own father because he found out that the phase of his condo community, he was the first one, so he couldn't get a loan despite his high credit score and, enough money to pay the loan. So there are a lot of people who would get credit, I think, if Fannie and Freddie came out of conservatorship, and it might free up more. We kept thinking that would build. And I don't know, maybe it will, maybe it won't. They're just like getting you off of your dad's couch, Robbie. They're good and bad, right? The idea is if you're living in your dad's house, you're safe, right? And you're keeping the world safe from you, but you're not maybe making the money you could, or generating the income, or going out and building more businesses and opportunities. So, when you do that, you might make some mistakes along the way. And certainly, we saw a lot of programs that the GSC pushed that ended up ripe for abuse. Absolutely. And how the secondary market pricing drove certain, Nina loans, or the whole, you can fog a mirror, you can get a loan. Or we saw a lot of pushing for certain types of loans, people who weren't homeowners, and they were sucked in by purported, developers, and there was fraud and the rest. But, certainly we've learned a lot from that. And since Fannie and Freddie came under conservatorship, we've had a whole slew of laws that are in effect to protect against that. So under any administration, Congress would have to change those. So those aren't going anywhere anytime soon. So I just feel like it might create more opportunities despite some of the bad things that would happen. And you're right, there's a ton of money there, but Republicans are about smaller government as well. And so getting rid of that, is just consistent with the theme.
Right. But you're right, Robbie. There is a financial incentive for them not to do anything, which is why we're almost by the end of the Trump administration, it'll be 2 decades that they will have been under conservatorship if something doesn't change. That's an awfully long time. And the reason for that has been because of the sweep that they've had of the earnings of those entities, which have helped with the deficit and other things along the way.
Well,
So there's that.
Can you voice what you would like to see from Trump's next head of FHFA? Because there was some discourse out there. Mark Calabria has never worked for a mortgage company. He doesn't like Fannie and Freddie. This whole remit was to weaken them to the point where this was an inevitability. And that's viewed pretty negatively from those in the mortgage industry. What would you like to see of the next head of the FHFA?
I'd like to see them be pragmatic about it, about how they go about the privatization or the spinning it back to where it's no longer under conservatorship. I think that it needs to be done over a period of time that works, so it's not too much a shock to the system. So I think someone who has that pragmatic view of that and understands that because if you do it too quickly, you are going to have a shock to the system and a shock to the interest rates and a shock to just the industry as a whole. I think they have to pay very careful attention to the liquidity that the entities provide to the marketplace, because if you completely privatize them the way that Trump 1.0 sort of looked at, where it didn't even have as much of the guarantee that we're become so accustomed to, that might help others in terms of competing against Fannie and Freddie, but it might not be beneficial to consumers or the mortgage industry that have actually operated under that model for so long. And we've been well served as a society in terms of that. So someone who has that recognition of the history and the role that they've played positively, as well, taking into account that some of the negative things that happened before 2008 have mostly been addressed legislatively, as Loretta pointed out, and the ability to repay and other things that have sort of been adopted since then to make that risk profile for Fannie and Freddie go down. So I'd like to have someone who is industry sort of savvy with respect to it, understands the pragmatic approach of it, and also doesn't want to do anything too quickly, but has a good plan for actually doing it over time in a way that poses the least risk to the industry as a whole. Loretta, what are your thoughts?
Absolutely. I mean, someone with some in the trenches experience, knowing the day-to-day challenges of serving consumers, answering to regulators, getting your loans delivered in the secondary market,
right.
Finding opportunities, managing risk, and someone who, they can look at the secondary market, look at the long game, look at the MSRs, look at how things have boomeranged.
Right.
Maybe somebody who does have some, depository experience that has a unique way or different way than perhaps all IMBs might, as far as risk reserves and how to manage things, because that was a problem too, before things blew up. So, there's not going to be one person who's the unicorn who fits that, but definitely to have something that's, inside, some inside experience.
The people are saying Loretta for FHFA.
Loretta.
I second
I
that
get a
nomination.
royal title. Can it be like Queen? Do I get a royal title?
I can. That'd be good. Well, let's end on this. If you had to guess when we would get more clarity on a plan or a proposal for a plan, when would you expect something to come down the pike?
I don't expect anything until well into the administration. I think the late 2025 would be the soonest you'd see anything. I think it'll be later than that. I think it'll be more into, just because, again, I think the practicalities of this are that it could disrupt the interest rate environment, making interest rates go up. And I think that's going to be problematic for the administration, given just the overall interest environment today.
Gosh, I don't know. Let me just guess. March 13, 2026. That's my birthday. Everyone mark it down. Call me then. I'll be at the FHFA.
You'll be the head of it.
Bring me up. 2026. Yeah, that's it. March 13, 2026.
You'll be turning 34. It'll be a good, I'll try and
bingo. Right on. Right on.
Be good. I very much enjoyed this. Loretta, I appreciate having you on. I thought you brought some really good perspectives. So hopefully we can have you back.
Thanks. I mean, I can't be Brian Levy, but I am what I am,
You're awesome.
Fantastic today. And Mr. Green, thank you as always. And a big thank you to Polunsky Beitel Green for sponsoring the show. Check them out at mortgagelaw.com. We will see everybody next month.
Our
Thank
pleasure,
you.
Robbie.
Be
Thank you.
good.
Thanks, everyone.